looks at it as, well, if we measured from the day at the end of the day after reporting earnings, right? So if it had reported earnings, it could get repriced that day. We look at the end of day's price and we measure it up to the end of day's price before the next earnings. So that's what this is looking at, that drift that doesn't include any the repricing of the earnings. So there are two things here. The the green or red bar represents green for positive earnings drift, red for a negative earnings drifts. So here we could see, between these earnings, Meta was down. Let me see, 26%. The next one, it was down 17%. Here it was down. Now we got up over here. The earnings effect this blue bar, that shows you what it did the day of the earnings. Okay, so we see that it was, the drift up to the earnings was negative. When it announced earnings, then the stock price was positive 17%. Okay, so it gives you both of those measurements to compare to each other. So let's come down to the table, and here just kind of lets you see if you spot any type of patterns or trends or of what's going on. So here we have a positive drift followed by positive earnings effect, positive drift followed by positive earnings effect. So this will kind of just show you that history. And in this table below, these are summary stats, and these are the individual earnings. And there are a couple things here. Up here are the averages. Then you have absolute averages, and then you have like median, minimum, max. On this first column here, the average, that gives you the average price impact on the day of earnings. Okay, so this is on average. If we took the actual earnings day, like what did it do from the previous day's close to the next day's close,